Hi and Assalamualaikum. My name is Nur Adri Izzah binti Abdul Mane. My matric number is S50073. I will present relation to the unit trust as my group project of specialized industry. So this is my group members and this is the table of contents. For overview, our group have chosen First Real Estate Investment Trust as our chosen company. In terms of background and sector of the company, First Real Estate Investment Trust, or called as First REIT or the Trust, is a real estate investment trust established in Malaysia and constituted by the trust deed date 28 September 2006. First REIT was listed on the main market of Bursa Malaysia, Security Berhad on 21 December 2006. First REIT is one of the largest Malaysian-based commercial real estate investment trusts and own a diverse portfolio of 9 properties located in Klang Valley, Melaka and Penang with a total net lettables area of approximately 3.2 million square feet as at 21 March 2021. Next, the history of the First. First REIT managed by REITs, which is responsible for the management and administration of First REITs, as well as the implementation of First REITs investment and business strategies. The manager was incorporated in Malaysia on 20 April 2006 and is wholly owned by REIT Holdings Sdn Bhd, which in turn is 70% owned by M Investment Group Berhad and 30% owned by Corp Properties Berhad. IAGB is a wholly owned subsidiary of MMB Holdings Berhad, which is a public limited liability company incorporates and domiciliates in Malaysia. There have been no significant change in the nature of principal activities. MPROP is a 69% owned subsidiary of Corp Group Berhad, which is substantive shareholder of AMMB, the unlimited holding company of MREITs. MPROP is a company incorporated in Malaysia and principally involved in the property development, investment and management. Its property portfolio includes projects in Malaysia and key global cities such as London, Madrid and Tokyo. Next, we move to the accounting policies and the standard. The accounting standard specify how transactions and other events are to be recognized, measured, presented and disclosed in the financial statement. The significant accounting policies and standards related to the specialized industry, which is First REITs, are Exposure Draft 26 or we call as ED 26, which issued by the MASB. For the preparation of financial statement, the company using historical cost basis in the financial statement. This historical pricing method under which transaction done based on the price which was determined yesterday. The financial statement also presented in Ringgit Malaysia, functional currency of the trust. In terms of statement of the compliance, the financial statement of the trust has been prepared in accordance with the provisions of DITS, the Securities Commission Malaysia's guidelines on listed real estate investment trust, Malaysia Financial Reporting Standard, which is MFRS, and applicable securities law in Malaysia. In terms of initial recognition, investment property are measured at the cost, which is the fair value of the considerations given to acquire it. The carry amount included the cost of replacing part of an existing investment property at the time the cost is incurred if the recognition criteria are met and exclude the cost of day-to-day servicing of the investment property. Subsequent to initial recognition, investment properties are stated at fair value which reflect the market condition at the reporting dates. The fair value is arrived at by reference to market evidence of transaction price for similar properties and is valued by registered independent valuer having appropriate recognitions, professions, qualifications and recent experience in the locations and category of property being valued. Gain and loss arising from change in the fair value of investment properties are included in the profit or loss in the years in which they arise. Investment property are derecognized upon disposal or when they are permanently withdrawn from use and no future economic benefit expected from their disposal. On this disposal, the difference between the net disposal proceed and the carrying amount is recognized in profit or loss. Besides, for managers and trustee fee, they are actually recognized on accrual basis in accordance with the service rendered to the customer. Thank you, and I will pass to the next presenter.
Assalamualaikum and hello to Dr. Shah and fellow friends. My name is Nur Hamizah binti Hazli and my metric number is S50417. So in this presentation, I would like to explain about the types and classifications of interest rate regarding of their disclosures on accounting for revenue, asset, liabilities and expenses. So let's get started. Now, let's take a look for interest rate revenue. According to the annual report of the company for the year 2019 and 2020, the main revenue consists of gross rental income, car park income, and other income. Revenue is recognized insofar as economic benefits are likely to flow to the company and revenue can be measured reliably. Before income is recognized, the following specific recognition criteria must be met. The company has adopted the standard with the amended retrospective method in compliance with the transitional provision in MFRS 15 without any restatement of comparable information. There was no modification of the amounts recognized in the financial statement since the adoption of MFRS 15 had no major financial effect since it recognized revenue in a manner compatible with MFRS 15. The revenue generated includes rental and services costs, property parking income, and other miscellaneous tenants recapturing. The rental income generated by leases on investment properties is directly accounted for in the lease terms. The unrealized revenue refers to the accrued unbilled rental income receivable pursuant to the requirements of MFRS 16 which leases. Recognized on a straight line basis, the total cost of incentive for leases is recognized as a reduction in rental income on a straight line basis over the rental period. Property expenses include property management charges, rent discontinuation, appraisals, and other investor property outgoings. Now, let's move to their assets. In the annual report for the year 2019, the company's non-current assets comprise of investment properties and receivables. However, in the year 2020, there's one item that is capitalized as non-current asset, which is a right of use asset. Current assets of the company are receivable, bank deposit and cash, and bank balance. Investment properties are properties held to gain rent or capital appreciation, or both instead of being used in the manufacture, supply, administrative purposes, or sale of products or services in the usual course of business. The corporation has adopted MFRS 140 in connection with investment properties, whether or not the property fulfills or no longer meets the criteria of an investment property. The corporation uses the simplified approach of MFRS 9 to calculate the estimated credit loss for trade receivable or ECL. Receivables deposit with financial institutions and balance forming a considerable proportion of the financial asset of the company fulfill the categorization requirements at amortized cost, and thus no changes have been made in the accounting of those assets. Since 1st April 2019, the company has adopted MFRS 16 for the first time. In its transition to MFRS 16, the company has chosen a simpler transition approach that does not restate comparative amounts. MFRS 16, which replaced MFRS 117, eliminates the rental classification as an either financing lease or an operational lease by the renter. MFRS 16 requires the rental authority to account for all leases in accordance with a single balance sheet model similar to the accounting of the financial lease under MFRS 117, which includes recognizing the right of use of the underlying asset and the lease responsibility for future lease payments. So, we have seen their revenue and asset. What about their liabilities? On the other hand, in 2019, the company disclosed 3 items under non-current liabilities. During 2020, 2 items have been added, which deferred tax liabilities and lease liabilities. The company has applied MFRS 9, which financial instruments to classify the rental deposit, borrowing, derivative, and payables. Deferred tax liabilities are recognized for all taxable temporary differences. MFRS 16 requires a lessee to account for all leases under a single on-balance sheet model similar to the accounting for a finance lease under MFRS 117, which involves the recognition of a right of use of the underlying asset and lease liability reflecting future lease payments. That's all from me. Now I will pass to the next presenter, Shazlina, to explain about the initial recognition and measurement about the disclosure of MFIRST rate on accounting policy. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Nur Shazlina binti Muhammad Sah. My metric number is S50502. I will be presenting about recognition and measurement. Revenue. The revenue in MFIRST will be recognized when the performance obligation is satisfied, meaning that when the goods are transferred and services are rendered to the customers. Before recognizing the revenue, MFIRST applied a 5-step model. In 2019, the company adopted the modified retrospective approach for the standard without any adjustment to the comparative information. In 2020, MFIRST stated that they measured the revenue at the amount of consideration which it expects to be entitled in exchange for transferring the goods and services to the customers, and the amounts collected on behalf of the third parties are excluded. If there are any differences in the amount of consideration, the company will estimate the amount for consideration based on the expected value. When the performance obligation is more than one, the amount of consideration will be allocated to each of the performance obligation based on the standalone prices of the goods or services in the contract. Next, the company will determine whether the performance obligation is transferred over time or at a point in time. This can clearly be seen that in 2020, MFIRST disclosed in detail on how they recognize their revenue by using MFRS 15, while in 2019, MFIRST just disclosed in general. Next, lease. For the recognition, the initial direct cost incurred added to the carrying amount of the lease asset and recognized over the lease term on the same basis as rental income. Operating leases on investment properties use a straight line basis over the lease term. Last but not least, property expenses, which also included in the revenue of the company in 2019 and 2020. Property expenses measured in accordance with the Valuers, Appraisers and Estate Agent Act 1981. Asset. For the recognition and measurement. Investment property, which is MFRS 140. For the initial recognition, measured investment properties initially at cost, including the transaction cost. The cost of replacing part of an existing investment property will be included in the carrying amount at the time the cost is incurred and will exclude all of the costs of day-to-day servicing the investment property. While for the subsequent measurement, it will be recorded at fair value by referring to the market price at the reporting date. Next, receivable. Trade receivable of MFIRST are recognized at amortized cost, which complies with MFRS 9 financial instruments under financial assets. While for the subsequent measurement, trade receivable are subsequently measured using the effective interest method and subjected to impairment. In 2020, there is an additional item in the non-current asset, which is right of use asset. The company measured right of use asset at cost, less any accumulated depreciation and impairment losses, and adjusted for any remeasurement of lease liabilities. The cost includes the amount of lease liability recognized, initial direct costs that incurred and lease payments that were made at or before the commencement date, and plus any initial direct costs incurred. The right of use assets are depreciated in compliance with the principle in MFRS 116, property, plant and equipment, while for the recognition of the current asset, which consists of cash, bank and deposit with financial institution, stated at amortized cost, and it is under MFRS 9 financial instruments. Liabilities. In MFIRST, liabilities can be related with MFRS 9 financial instruments under financial liabilities. It will be recognized when the company becomes a party to the contractual provisions of the instrument. Financial liabilities are recognized at fair value and for the loans, borrowings, and payables net of directly attributable transaction costs. There is a derivative in the liabilities of MFIRST. Derivative stated at fair value, and it will be asset if there is positive value in the fair value, and will be recorded as liability if the fair value is negative. In this company, the derivative is negative and it is stated as liabilities in their statement of financial position. Last question. Evaluate whether disclosures related to the accounting for the above items are made in accordance with relevant standards. first disclosed that in the notes to the financial statements, notes number 2, it is stated that both years 2019 and 2020, the company prepared the financial statements complying with the provision of the DID, the Securities Commission Malaysia's guideline on listed real estate investment trusts, Malaysian Financial Reporting Standards (MFRS), International Financial Reporting Standards (IFRS), and securities laws in Malaysia. Some of the items that the company records are based on the professional estimation as well as their judgments. For example, property expenses in the revenue section. That's all from us. Thank you.